gentlemen, welcome to Stock Dirty to Me. I am, of course, your host with the most, Phil Better, and with me, as always, is my boy Tony and Dalt, the new shaved look, which is freaking everybody else out. I can tell you that much. But, ladies and gentlemen, this is Stock Dirty to Me, the podcast where we break down stocks that you guys voted on in the group. I am, of course, Phil Better, and everybody's just happy. Cheers to everyone.
What are you drinking today, guys?
I got Jameson, and I haven't done Jameson in a while. It's been a week.
Well, you're always
an original. It's a local lager.
Nice.
All right.
In Dundas, Ontario.
Dundas, Ontario. Excellent. Guys, how has your week been with the stock market? Are you up? Are you down? Are you confused by everything? Because apparently the group is confused as well.
I'm definitely up on the week now.
Yeah. After today, I'm up.
Yesterday was a huge
Monday. Yeah, Monday was like a 2% drop or so, and then Tuesday and today all came back. So
yep.
There you go.
Like, you don't panic. You don't panic sell. You don't freak out and change your strategy. Just stick to the plan and keep doing what you're doing, and it comes back.
That's it.
I love it. For those joining us right now, this is Stock Dirty. If you want to leave a comment down below saying, hey, how's it going? Ask us questions. We're going to be jumping into 4 stocks today that we're breaking down, a bit unusual. We usually do 3. We got Coinbase, Netflix, Bank of America, and of course, Schwab. So when we jump into them, let us know what you think. Of course, if you have other stocks you want us to break down on next week's show, leave that in the show notes. Hi, y'all. Remember, if you want us to be able to see your name, you need to click and let StreamYard have access so that we can see your name, or else you'll just show up as a hi, y'all Facebook user. But we're going to start with Coinbase. Tony, how about you start us off with Coinbase? I'll just bring up the graphic.
Yeah, throw up the did I send you the earnings or the year to date?
Year to date.
All right. So year to date, obviously, Coinbase is down, 30%-ish or so. We knew that Coinbase was going to start out pretty overvalued to begin with. And that's exactly what happened. I think they started out around 380 when they IPO'd. They went direct listing. And they've done nothing but fall ever since. But the thing about Coinbase is they're the largest crypto exchange in the U.S. They're the first publicly traded crypto exchange in the U.S. And this company, their current debt ratio is pretty amazing. It's 0.29. So they have very low debt. Their current price to book, though, is, as of July 19th, is 8.36 to 1. So I like to look at stocks that are 3 to 1 or less. That's kind of my rule. So clearly this is definitely trading. It's still trading pretty high if you're going off the price to book value. And for those that haven't been watching before, I know I've explained this a couple times, but the price to book value is just the price of the market. So it's their stock price compared to their actual book price of what the company's actually worth based on their book value. So right now they're trading 8 times higher than what their book value actually is. So I think there's just a lot of hype with this. People love crypto. A lot of people think crypto is the future. And, it started out at a really high valuation. So if you bought in when it was really high, I wouldn't have bought in. I didn't buy in when it first IPO'd, and I'm still not going to buy it. I'm actually, if it falls to like 200, I might buy a couple shares. But as of right now, it's still pretty high. But this is one of those companies that I think that 5 years from now, their price is going to be higher. And they make a lot of money. I don't know if you could can you pull up Coinbase earnings on the screen?
Give me a second. Let
me
just
Google.
That's
Google
what I'm
Coinbase.
doing.
Yeah.
Just give me a second. I just don't want everybody to see what I have on my screen. So
they are top 10 most profitable companies in the U.S.
I'm doing Coinbase. What again?
Profitable in
Coinbase earnings
in the stock market.
Yeah, you'll see it pop right up right on Google. Just so people could see what we're looking at.
There we go. Quarterly image. Just get some images here. See if there's anything. I think this Yeah, okay. Let's make
So-
that the big screen.
So all we have is September of 2020 to the first quarter of this year right now. That's all I'm seeing. But if you go and you look at their earnings, they started out with a net income of $129 million when their first reported quarterly earnings, and now the latest.
Please tell me this is the right one.
Yeah.
Okay,
Yeah.
good.
So right now their latest net income for March, for the first quarter of the year, they basically they multiplied their earnings by 6 times the previous quarter, their net income. So that's their income after all of their expenses. Their net income is $771 million, as opposed to the last quarter, which was $129 million. And they have a lot of cash on hand. They have $2 billion on hand. They do have a pretty high operating income. And I don't know, I think this is one of those situations where they jump so much because of the popularity of crypto. And a lot of people found out about Coinbase when the IPO, so they're going on the app, they're buying crypto. I don't know if they're going to be able to sustain that type of growth. It's probably not very likely at all. I think they're going to level out at some point, but they are very profitable, and I think they're going to continue to be profitable. So as far as investing in it, I'm not going to invest in it right now. But if they fell under, say, 200, I might buy 5-10 shares and just ride it out for 5 years. But right now, I'm not going to invest in it. So.
No problem there. Understandable. Dalt, do you want to add anything to what our amazing Tony from the Stock Bro podcast
I wouldn't say
provided?
amazing. I wouldn't say
Well, you're amazing to me, and that's all that matters. Okay.
yeah.
You
Okay.
help me out a lot, and you help a lot of our members in the group.
Thank you. I appreciate
So
it.
Yeah.
Dalt's less amazing now without the with the shaveness. It's just really weird to see.
I try to keep it smooth. So yeah, a lot of what Tony said is correct. I was willing to buy at 250, and as it kept climbing down, as it moved through that level, I kind of took away my limit order. So I did the same thing with Airbnb too. I kind of just let them go. It's still on my watch list, and it's still one of the top 3 companies I'll be looking at taking a position in, whether it be Airbnb, Coinbase, or Upwork. Those are the 3 that I'm really targeting right now. As Tony said, yeah, the company is still riding high, and I agree. Like 200, 210, I might be a buyer if it goes back down there again, because that first quarter was absolutely on fire. So they usually. Coinbase didn't need the money. As Tony said, it was a direct listing. They didn't need to IPO. They don't lose money. This is one of the most profitable companies in the United States, probably the world. That first quarter profit margin was over 42%, which puts them up there with MasterCard, Visa, and VeriSign, 3 of the most profitable companies also in the US and the world. So this company makes a lot of money. They're more profitable than Google and Facebook and a lot of other FANG stocks. And they do a good job. They don't lose money. They're very, very fiscally conservative. They're not in danger of not paying their bills. All those current liabilities are in check. So yeah, if this came down to a point to a lot more reasonable level, yeah, I'd definitely be a buyer closer to 200. If this were to take a huge dive off a cliff and land somewhere between 150 and 180, I'd certainly put a lot of money there, a few $1,000s, that's for sure. I like the company. I always have. They are the biggest leader, as Tony said, in the United States. They are 10% of global cryptocurrency volume. Coinbase is responsible for 10% of all that. So
I have a question for you. For all the people that bought Coinbase right at the IPO, or they bought it, say, over $300, what's your advice to them right now for those people that own it, $100 plus what it is right now? Would you say average down? Would you say hold?
I would say hold and see what they do in Q2. Like you said, what they did in the first quarter of 2021, compared to what they did in the fourth quarter was huge. Like, yeah,
I saw that jump. I was happy.
The revenue jump is ridiculous, and they went. Usually, you don't see companies that have a 25% profit margin swinging to a 42% profit margin. That usually doesn't happen.
Unless someone messes up.
Yeah, and if they can grow, like if they come in above $2 billion in revenue and that 42% profit margin holds, I would say you got to hold, because eventually this is going to take off, because they're not losing money, and the bigger that number gets, the revenue number gets, and the more they can stick that profit margin, eventually this is going to come into fair value. Like right there, 49.17 billion. So yeah, I mean, like again,
this is one I think I probably, if I bought it at like 350, I may buy a couple more shares to average down.
Yeah,
but not too crazy.
Yeah,
but you know, I think the psyche of investors, the thing that Coinbase had going for them is crypto was exploding. We were on that little bull run where everything was going up, and the psyche of new investors, especially when they see things going up and up and up, they want to jump in and start buying. I was one of them, and they don't think like, oh, the best time to buy is actually on the down end. Not while everything's going up, but while you're watching people make money, all your friends are posting pictures of their profiles.
Yeah.
I just made $1,000 on Dogecoin today. It makes you want to go download Coinbase and start buying. But when things are dropping, people get scared. So like you said, I'm curious to see how their earnings look for the next quarter.
Well, this is a timely question. Someone asked it. The person bought. Again, if you want your name to be shown up, make sure you click that link just above the video. It says StreamYard/something. You click that. That'll allow us to see your name, because I don't always get to see your name here. But they're asking, bought at 219, hold?
Oh, hell yeah.
Absolutely.
Yeah. You bought it at 219. That's a good price. Yep. I actually think they're probably going to fall. Maybe. I mean, I probably would have bought at 200 or maybe less, but I mean, I would definitely hold
at 219. Yeah, I would hold as well.
I always like to see like another quarter. I always like to see another quarter. Like even if I'm thinking about dropping something, if I have a loss in it, and I'm trying to get rid of it, I'm like, I'll wait till next quarter. And you know,
that
sure enough, next quarter.
Yeah, that was Sandra, by the way. I could see the names.
Thank you. Yeah, I don't have it up on my screen here because I have to show these beautiful charts. But yes, Sandra, thank you very much for asking that question. Yeah, so we're decided, if you have Coinbase right now in your market, go ahead and hold it. Or
honestly, I would hold that no matter what price you paid. I would hold.
There you go.
This is something you can hold for probably 5-10 years easily. So.
Yeah, this is, we know that crypto is not going away. It's only going to continue, and might as well own the largest, as you said, the market cap is at nearly $50 billion or 50 billion. I don't know what that means. I'm not a stock person. I'm just a host of a podcast, people. But it's nearly at 50, and like it's only going to go up, and crypto's just going to get more and more involved in our day-to-day life. So owning pretty much the shovel maker, if you will, using the gold during the gold rush.
Like you said, it's a good way to own crypto without directly buying crypto. You're buying the largest, stock in the largest exchange in the United States. So if you're scared of crypto, you can own it indirectly with Coinbase.
Yeah, there you go. Ladies and gentlemen, some wise wisdom again from the amazing Tony and Dalt. We're going to move on to the next one, which is personally my favorite because I use this nearly every day. We're going to be bringing up Netflix, ladies and gentlemen.
Take it away, Dolph. Let's go.
Here's the 5-year so far, so that we have that. We do have another one that I'll show a little later.
All right, so Netflix. So we talked about this briefly. Whenever we talk about a particular stock, I always do a comparison. And so when we talked about Disney last week, I did get into Netflix a little bit. So yeah, Netflix is the online movie streaming leader. They have over 200 million subscribers. They are the only ones in the industry that have that. Closest would be, I think, Amazon Prime at 170 or 180. So they are the market leader. The one thing that I really like about these guys, besides that meteoric stock price rise of nearly 500% over the last 5 years. So gains 100% per year. So every year you would have doubled your money if you invested. So that's kind of crazy. Yeah, it's insane. But yeah, they've really taken the market by storm. And like I said last week, the one thing that I really like about this company is just the fact that when this started, it started at the same price that Disney Plus is at now. And don't kill me for saying this because I don't have Disney Plus, but it is at $7.99 a month, right?
No, it's Disney Plus.
Yeah.
Hold on, I think it is that.
You might be right. Yeah, I think you're right. Yeah.
So that's where Netflix started. Netflix is at what now? $12.99, $13.99 Canadian.
You know what's crazy? Yeah, it is. It is in the
So
double.
they've almost doubled.
I actually canceled my Netflix, and they keep sending me emails, be like, "Come back for $7.99 a month."
Really?
Yeah, because we share.
Oh wow.
Yeah, so they keep saying like, "Oh, come back for $7.99 a month." They're trying to get people back that canceled for the introductory price. Yeah.
Okay.
Let me see if I can find the email, post it up there. But yeah, it's pretty funny. I saw it today actually. I started chuckling. I was like, maybe I'm gonna do that and cancel.
I'm gonna do that now too. Yeah. Hell yeah.
I'm not gonna cancel. I'm too lazy.
But they've been able to move from that $7.99 level and almost double pricing, and they are still the market leader. They haven't really dipped off. There's still been subscriber growth every year. I found that quite interesting. And that's kind of the one knock I had on Disney Plus. Everybody's willing to get a streaming service when it's under $10 a month, but that's not sustainable. So like all things in life, they lure you in super cheap and then they have to raise pricing. And that sort of game is can you justify enough value on your platform? Can you make the switching costs high enough so that after we raise pricing, you still determine on your own that, hey, you know what? I knew I was getting a bargain at $7.99. It's still worth it at $12.99. And Netflix has been able to really do that. A lot of the Netflix original content is better than the stuff that's not Netflix original. I'm sure everybody's noticed that. So they have really built that up, and they've locked in the best actors and actresses is pretty much what it is. They've locked them up to huge contracts and they work exclusively for Netflix now. So they should be pumping out the best content. And they've really made that jump. So I've always liked them for that. Also, revenue growth from 2019 to 2020 was 25%. That's still a huge revenue growth for this stage of the company. And they're also profitable. So I think they're booking like just over a 10% profit margin, call it 11%. They make money. I think it's
$1.7 billion net income this past quarter.
Well, I just want to throw in this. I don't know if you guys read this, but I was reading recently that Netflix is going into the gaming world.
Yes. And I think that's going to be a big deal too. For all those you listening out there, or that are watching live right now, what subscription services do you have? The 16 people that are watching, do you guys primarily use Netflix? Do you use Disney Plus? Let us know. And also, do you think that Netflix gaming is going to overtake like something like Xbox Live or maybe Amazon Prime? So let us know your thoughts.
That's interesting. Tony, you sent me the second slide here.
Yeah.
Year to date.
Yeah, that's Netflix's year to date.
They're down only 0.77. That's an amazing 1.77% down. That's not bad.
Yeah, well, they're down.
That stock price momentum had to taper eventually.
Whoa, we just got a lot of people. So we got Netflix, Hulu, and I don't know, a Friendly TV. I don't know. We have Sabrina coming in with Netflix, Disney, Amazon, Hulu. She has all 4 kids. Understandable. I don't have 4 kids, and I'm only missing Hulu there. And then we got another one, Netflix, Hulu, and Prime. I love to see them offer gaming. Yes, it's going to be coming soon. I do know they mentioned that. But Tony, I believe you have anything else to add for
one more thing on the Netflix profitability. So 2020, they had an 11% profit margin. In the first quarter of this year, they clocked in at over 24%. So they also have been able to raise their profit this year. So I like the company. I don't think there's anything wrong with it. I always say invest in your market share leaders, invest in companies that make money, and invest in companies that are able to grow money. And I don't see anything wrong.
if you're into streaming services and you believe in them, I know there's an ETF out there that has like Netflix, Hulu, and all these streaming services packaged into the ETF. What is it?
I think it's subs, SUBs.
Yeah, something like that. You can check. I don't really know too much about how they're doing as far as what their earnings are, or not earnings, what their year to date is or anything. But you can check that out if you believe in those, because especially someone like Sandra that has 4 or 5 streaming services, maybe you want to invest in what you're using.
You go. That's a smart choice there. Tony, anything else you want to add to Netflix, or should we move on to one of your favorites?
Give us something, Tony. Give us something.
No, I have a question for Dalt. So Netflix, if people want to buy it, is now a good time to buy Netflix?
Yes.
All right.
Yes.
There you go, ladies and gentlemen. If you're interested in buying Netflix, you can go ahead. Oh, we got another person. Netflix, Disney Plus, Prime, and Hulu. Again,
I got all those too. Yeah, everybody's got them.
If you have, like, Netflix is a guarantee. If you're using Netflix, might as well own Netflix and be both a consumer and an owner.
You're not going to go wrong. Yeah,
it's crazy. We all canceled cable and cut the cord so we can save some money, but now we're all buying 5 or 6 different streaming services and spending the money anyways.
Yep.
But
I only have Prime. I don't have cable, so I have Prime, and Prime was kind of just like I pay the $75 per year to get free 2-day shipping.
Yeah.
Like, Prime Video is just a bonus, like, honestly. And then there's Netflix I have for just general movie and TV shows, and then I have DAZN for the sports, for boxing and football. Yeah. So
yeah. So I mean, these streaming services are probably all the future, and they're just going to get better and better. So why not? Why not invest in them?
There you go. There you go. All right. So now we're going to move on to our third, but not final, Bank of America.
Yes.
Tony, you love Bank of America,
I love
don't
Bank
you?
of America.
all right, let's get it.
I actually bought 50 shares of Bank of America when it was like $36. And I loved it at that price. And it did go up to like 44, and then it had a little bit of a slide, and now it's back down to like 38. And I'm actually thinking about buying some more, and here's why. So for 6 straight quarters, Bank of America.
Dalt, you look so young.
He does. He looks like a baby.
He does.
A newborn baby. So Bank of America for 5 straight quarters has increased their revenue now. And like I said, I like to use the price to book ratio. And right now, as of today, they're at 1.07 to 1 ratio, which is that's one of the lowest they've been at for a while, since I bought it at like 35 or 36. And their income says it all. I mean, can you pull those up on the screen so people could see it, Phil?
Yeah, give me a second. Oh, that's not what I wanted to do. No, that's not. Mouse, agree with me. Stop being annoying.
So as of this, if you look at their income, 5 straight quarters. So we're going from 4 billion to 4.8 billion to 5.4 billion to 8.1 billion to 9.2 billion. And this is not their revenue. This is their net revenue. This is how much they're making. So if you're looking at just revenue this quarter, they've had 23 billion in revenue this quarter, and they net 9.2 billion.
That's 1.3 cents per share. Holy shit.
Yeah. So their profit margin is 40%. They have $260 billion cash on hand, which is pretty crazy. And the other thing that I like about this is Warren Buffett's second largest holding, and they pay a dividend. They pay a 72-cent per year dividend. I mean, what's not to love? I think personally, in my opinion, I think next year this stock's going to be around $50 by the end of next year. So that's just my opinion, and I'm going to hold this for the long term. And especially with interest rates rising, typically banks are going to do well with interest rates rising, and they're going to make even more money off of those interests from the loans. So we'll see what happens, but I'm a big believer in Bank of America. So
here we go. We have a question here. Why do you think the price is falling?
That's a good question. I don't know for sure. I've read a couple different articles on why. All I can do is really speculate. I guess the bank earnings have been incredible, and I'm wondering, some of the articles I'm reading, people think that they've made such huge profits that can they keep sustaining those profits? I say yes, because they're banks and they're backed by the government, and they're not going to go out of business anytime soon.
I can tell you from working at a bank.
Yeah.
Even during COVID, we were making money hand over fist.
Yeah.
So banks and being the Bank of America, really.
And the other incredible thing about not all the banks, but Bank of America, they didn't even cut their dividend at all during COVID. And some banks like Wells Fargo and others had to cut their dividends because they were in a lot of trouble. They got stress tests. These banks get stress tests by the Federal Reserve.
They do now. Yeah.
During the pandemic, and Bank of America was one of the strongest ones financially, along with I think it was J.P. Morgan, and I forget the other one. There was the top three.
Always Jamie Dimon.
Yeah. So J.P. Morgan, Bank of America, those are great banks to invest in. Personally, I think those are going to be great long-term holds. And the great thing I like about this episode is we picked 3 companies that are all profitable. They're all making money, and I should say you guys picked 3 companies. That's right. They're all, and I love being positive. I hate giving bad news about stocks.
So we just got 2 questions here. We have DFS, which is the Discovery Financial Services. Discovery. We're going to talk about. Yeah. We should talk about that next week. I'll put it on the list, and people can vote on that stock. But we have also someone giving us an update on the ETF that has some of the streaming service its subs. It's 11.77 per share. Net ratio is 0.75%. ETF for streaming services, but no Prime and no Hulu. Thank you, whoever gave us that stuff.
There you go.
I haven't done enough research on that, but that's a good one that we might do in a future episode.
Definitely going to write that down. Give me a second.
We can put that in the voting. Excuse me, the voting poll for next week. So that's good.
We got that, and
that is a high expense ratio, 0.75.
I don't know what that means.
That's how much so at 0.75, every like $10,000 you have invested per year, they're going to take $75 out of it.
That's not fair.
It's not bad. It's not bad, but it's kind of high, as we'll see with the ETF we get to at some point. But anyways, I'm going to stop talking and let Dalt
cover the Bank of America from Canada.
Yeah, Bank of America. I don't know how they're so profitable. I don't know how. They've got to be the most profitable bank when I look at that. When I look at those earnings, those profit margins are over 30%. I don't know how they're doing that. Our banks here in Canada don't make that. We have less than 10% profit margins up here. Bank of New York Mellon only has like 24%. So Bank of America is definitely a leader. I don't know what they're doing, but they're doing something over there to squeeze kind of the returns that you wouldn't expect just from loans. I expect, though, when you look at their subsidiaries, you'll probably find the answer as to where they're generating that revenue from. Whatever it is, it's worked. And I didn't know that they were the only company not to lower their dividend. So that's
I don't know if they're the only one, but they didn't lower their dividend, because I don't think they're the only one, but they're one of a couple of banks.
Okay.
Yeah.
I know the Fed suspended some bank dividend payments during the pandemic.
Wells Fargo was one of the ones that got hit.
Okay.
Yeah.
So I'm just taking a look, Dalt, because I'm a Canadian, you're a Canadian. I was taking a look at 2 of the biggest Canadian banks here, RBC and Toronto Dominion. RBC was trading at give me a second, like 126.30. That's what it closed today at.
Yeah, it's our biggest bank. Yeah,
that's the biggest bank, and it's doing pretty well. It's at nearly at its 52-week high. But I also look at TD, and TD is only trading at 82.85, which is weird because it's the second largest bank in Canada. So it's interesting seeing how the different banks.
Stock price really doesn't matter. It's more like the market the
The
market share.
profitability is
Yeah.
drastically different between the two, though.
Yeah.
But, stock prices don't really matter. I'm sure TD has
Their market cap. I don't know.
significantly more shares or something to
Market cap for TD is at 150, and for RBC 179.
Yeah.
Yeah, so there we go. They don't have the same market cap as Bank of America because we're smaller than you guys.
I like those banks though. I would
RBC
invest in those banks too, probably.
Yeah, RBC is one of the best banks to go into. But anyways, we're moving on to the next stock, which is
an ETF.
An ETF that we'll bring it up here. It's Schwab's U.S. Dividend ETF.
SCHD.
There you go. Who's taking the floor on this one, Tony or Dalt?
Tony, take the floor on this one. This is your one.
I love this ETF. That's it. Done.
That's all you. Ladies and gentlemen, that's the show. Have a great day.
Yeah.
Oh, there's more to it than that.
This is by far my favorite ETF. I think I have I have like 4,000 in this ETF, and the reason why I love this ETF is because it's a high dividend ETF that delivers returns on par with the S&P 500, and actually this year it's beating the S&P 500, and it has double the dividend of the S&P 500, and it has great blue chip stocks.
Look at this. Someone is thanking you, Tony, because they bought $1,000 worth of Schwab.
$1,000 well spent.
Yeah, that's going to make you a nice bit of money in the long run.
$30 in dividends right there per year.
I'm glad to hear someone taking.
Congrats on that. Who was that? I have to find out who that was.
In fact, every time that's one of the ones I invest in weekly, and I actually have been waiting for a big dip because I may throw another big chunk of money in there. I like that one a lot. It's my favorite dividend ETF because the biggest reason why is because the capital appreciation is so good and they're so consistent and they have a good track record. But also, like we talked about with expense ratios, their expense ratio is 0.06, I believe, or 0.08. We have to have our
boom. Look at this.
Yeah, right there.
And again, even more love from Tony. Yeah. Remember, we only like wanting to see you guys win. That's why we make these suggestions to steer you away from some of the ones we don't believe in. But go ahead, Tony. I said,
their expense ratio is like 0.06 on that, where you're paying $6 per $10,000 invested per year. So it's not really going to eat at your gains or your dividends at all. And it's a qualified dividend ETF. So you're going to pay a lower tax rate on it in the US. So to me, I mean, there's 0.06. Thank you. So there's really not much to dislike about it. I will say they do switch up the companies often, but can you throw the top companies up on the screen?
Yeah, I think. Yeah, here we go.
I really like the top holdings last quarter when I was looking at it, but I haven't seen the new ones yet. So we got Merck, Home Depot. What's the third one? Texas Instrument.
So I'll read them off to you.
Yeah.
We got Merck, the Home Depot, Texas Instruments, Broadco, Amgen, PepsiCo, BlackRock, Pfizer, Cisco, and Verizon. Look, just with Home Depot alone, with the price of lumber that skyrocketed for some reason, that was
Well, yeah, exactly. Well, I love right off the bat. I love Home Depot. I love Pepsi. Pfizer, I like Pfizer. Merck, I mean, what's not to like about Merck? There's a couple in there I'm not super fond about, but those are out of those 10. Out of those 10, there's like 5 I feel great about those. The other ones but the rest of the holdings too. That I saw the full list. They have, Coca-Cola. They have a lot of other really great stocks in there. So I don't know. It's just I don't really have anything negative to say about it, to be honest. So I'll hand it over to Dalton.
SCHD is certainly. I think if I was going to own a ETF that I was looking for dividend income from, I would certainly buy SCHD. I'll tell you why. A lot of people are chasing a lot of other dividend ETFs, and the trade-off in a lot of other ETFs is extremely high between dividends and capital gains. And I think SCHD, the Schwab US Dividend Equity ETF, is a fair compromise between receiving a above average dividend with also adequate capital gains. The last 5 years, it's managed to keep up with say VU. Over the next 5 years, I don't think it'll quite be that close, but you do get that 2.8% dividend, which is extremely high. When your top holding is Pepsi, Home Depot, Pfizer, eventually that's going to catch up with you. That performance over the last five years is not always gonna be there, but this I can see. I'd be very, very surprised if this would earn less than 70% over any 5-year period. So I think the capital gains are great. And I think that dividend that you get, that 2.8% every year, if you're looking for a dividend ETF, this is the one that you have to have. There's no way around that. Every other place that you look, you might get double, you might get a 4 to 6% dividend in other dividend ETFs, but your capital gains, you're sacrificing capital gains extremely. So I like this ETF. If I was going to hold a dividend ETF, the only one I would hold would be SCHD. I can say that for sure.
Love it.
So we just got a question here from someone in the group. Again, please, your questions all on the bottom. If you want to have your name shown, click the link above, because sometimes Facebook doesn't let us see it. But he goes, wow, would you drop DIVO in exchange for this one? DIVO expense ratio is 0.55, but a little cheaper per share.
I'm not entirely familiar with that.
I'm going to search it up quickly. We're going to get the answer here.
I would tell you no without looking, but
it's Amplify CWP Enhanced Dividend Income.
I got it here.
So it's actively managed right off the bat. So that's going to cost you some more in taxes. Hopefully you got that in a retirement fund. But
again, this is what you're seeing on screen right now. For those who don't know, this is the sectors that the Schwab US Dividend Quality ETF, or whatever it's called, is in. And you can see they're highly in the financial, industrial, and technology sectors, as well as consumer defense and healthcare are their main places that they invest. So you have that to know as well.
Okay, I just pulled it up. So DIVO is top 10 holdings: United Health Group, Apple, Microsoft, McDonald's, Visa, Johnson & Johnson, Nike, Honeywell, Chevron, Goldman Sachs.
Okay.
I'm very surprised to hear those holdings. And then when I look at the returns over the last 5 years, they are incredibly lackluster. I think once you leave that top 10, I think they all get to be very, very crappy. That would be my guess. Last five years, mind you, I don't think they had 5 years. I think they started early 2017. So
they do have 5 years. I have on the screen right now. Here, let me zoom in a bit.
They do.
I'm at the 5 years.
Yeah, I think it's 2017. I think it's 4 years.
4.
I think it's 4.
What's their dividend yield?
Yeah, they started in 2016, so it's about 5 years by now.
5% dividend yield with those companies in the top 10.
Yep.
That's strange. Because Microsoft pays and Apple pay very low dividends. So does Nike. So I'm surprised they have such a high. The rest of those stocks must be just a bunch of really high yield stocks with very bad returns.
Yes, that's exactly what my guess is. So 45%, like again, you would have earned less than half of what SCHD did over that time period, and you would have made less than double the dividend. When you factor in the amount of capital gains you miss every year, plus the additional dividend, SCHD whooped Devo's ass. So I would say yes. Again, if I was holding Devo, plus it's cheaper on the expense ratio, you would have made way more money in capital gains.
For what it's worth, Fidelity has that rated at a B-, and they have SCHD rated at an A+.
Yeah, SCHD is the best. It's really the best. It's the best of both worlds. You don't really have to sacrifice capital gains to get a healthy dividend. I think it's great.
Yeah, I think a lot of people, like you said, they chase dividends. Those top 10 in that fund are really good. They're
They
excellent.
are, yeah.
But the rest must be horrendous. And they must be just a lot of high yield companies with low returns, and that's just not sustainable. The thing with SCHD is it's steady, it's consistent, and it's sustainable. You're going to get close.
It has a nice growth over the year to date. If you look at it, it's a nice upward. It doesn't drop.
Yeah,
it's perfect. You need something boring, like my call Lloyd says. If your investing isn't boring, you're probably doing it wrong. And that's the truth. Investing is not supposed to be a fun thing. When you're day trading, yes, that's fun because you're trying to make money. But investing is a long-term game. It's boring as hell. That's it for.
I think I'd like to add too. If you were looking at another dividend ETF, another one that I like, and I do have a couple thousand in it, is VYM. It's Vanguard's high dividend. It's another one like SCHD, but it's not as good as SCHD, but it's another one with a very low expense ratio, a 3% yield, and you're going to get about maybe 8 to 10% capital return every year as well. So it's steady over the years. It's low expense. It's got good companies, and it's got a 3% yield that's safe and steady. So that's another one I like a lot. If you were looking for a couple dividend ETFs, so that would be my recommendation. So.
There you go. Yeah. Ladies and gentlemen, we're at the end of the episode, so we're going to start. Who wants to go first to say goodbye?
Dalt.
There you go, Dalt.
All right, guys. You know where to find me. If you don't, I always am going to keep pushing my articles up to the top, because I know sometimes we think that when me and the other admins talk, we're always thinking that everybody is in the group as much as we are every day, and that's not really the case. I know people are not in the group every day, and probably a lot of you guys aren't in there every week. So I'm always pushing my articles to the top so that if you do check in, you might catch some of my articles somewhere near the top. So that's why I keep doing that. And yeah, just keep viewing these live videos. I will pick someone that was here on the live. I'm always looking to see who it is. And I will pick someone that was here on live to give a free crypto giveaway. So the crypto giveaways are always going to be BNB, Binance Coin, and some associated BEP20 tokens. So I'll be giving those away to somebody. Angela won it last week, and somebody will win it this week. And then hopefully next month, I'll start doing 2 giveaways per week to 2 different people. So just keep tuning in, and yeah, that's all I have.
Excellent. Tony, let's bring you up onto the front page here, make you feel all embarrassed and stuff.
Yeah, so obviously you could find me in the group, like Dalt said, and you could check out my podcast. I'll drop the link in there. A lot of people in the group have seen it and seen my videos, and I also have a course for investing for beginners. If you're brand new to the group and you want to learn how to invest, I'll throw that link in there. It's really cheap. It's like $10, and it's really great for beginners just starting out that don't know stock market terminology and whatnot. We do provide a lot of free information anyways, but if you want something that's more structured from start to finish, that would maybe be something you want to take a look at. But yeah, keep watching our lives, keep answering the polls, and letting us know what stocks you want us to break down. And that's about it. Thanks for watching.
Excellent. Thank you very much, Tony. I am, of course, Phil Better, the host of Invest in Yourself, the Digital Entrepreneur Podcast, as well as about a myriad of other podcasts. I want to thank you guys for, joining us, commenting, sharing, liking, all that fun stuff. It helps us and makes this show better for you guys. And if you're interested to know when we go live, join our mailing list. It's growing by the day. We went from 0 to already 60 people. So I'm really happy for all you 60 people who have joined. We're going to continue, and eventually it's going to grow into a different type of newsletter. But for right now, it's just to let you know when we go live. And you can always email us at stockdirty2me in the email. And I think that's the email. I can't remember, but join the email list, reply to the email, and you'll be able to.
We'll put it in the link. We'll
put the email, everything, all the social medias as well, so that you can follow us there and support us. Ladies and gentlemen, I raise a glass to you. If you have beer, anything empty, I don't care. You guys are awesome. I thank you all for tuning in, and I wish you all a great night.
Thanks, everyone.